Hey guys, hope you are all having a fantastic Thursday. Today we didn't really see a lot going on in terms of news and developments. I am going to talk briefly about the Fed and Evergrande, and then recap today and call it a day. It was a very trashy day in terms of performance on the charts, though looking at a variety of statistics, buyers are clearly the dominant force for orders, even if the price does not reflect that. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. Let's begin with China. Chinese creditors have sued Evergrande for more than $13 billion for overdue payments. A court assigned to handle these civil lawsuits against Evergrande has accepted 367 cases with claims totaling around $13.2 billion. As reported by the Financial Times, analysts are saying that the timing of these claims demonstrates that domestic creditors have lost all confidence in Evergrande's ability to pay off its debts well before the default declaration. The reason why they are all rushing to the courts is so that they can be in a better position to get their money back in the event of a debt restructuring. This is a smart move, considering that not all borrowings are treated equally. The influx of creditor claims really began when their central bank criticized Evergrande's management back in August over its debt levels, and has continued to increase over time. Another thing I wanted to bring up is, do you guys remember when we talked about some money managers who started taking positions in Evergrande by buying bonds? More and more of these money managers have been pouring in as of late, betting that creditors will recover far more than the debt's current price suggests. Their analysis of the situation is that there is so much bad news surrounding Evergrande that they think it might be way undervalued because of it, and that a small bounce will come up. Firms from SC Lowy in Hong Kong all the way to New York-based Apollo Global Management have been taking positions backing Evergrande. I just thought this to be interesting, and actually smart. There is a lot of risk in doing this, but if the bet plays out as expected, these firms are going to make serious bank. The Wall Street Journal published an article today, one that quite shockingly surprised me at how well thought out and eloquent it was. Big shout out to Greg Ip for his phenomenal work. The man certainly sees the situation surround the Fed just like I do, but from a perspective as to what can we learn about all that has happened. The lesson that the Federal Reserve drew from the economy before the pandemic came was that unemployment could be at historically low levels without fueling inflation. This was the reason why the Fed made statements last year saying they would never raise rates, because the job market was simply so strong. This assumption, as you might know now, could not be any more wrong. This is one of the things that I mean by when I keep repeating that the Fed is simply making policy out of thin air. Simply put, they are being forced to prepare to raise interest rates to slow down the economy, even as the labor force remains far from where it was 2 years ago. 5 million fewer people are employed now than before the pandemic, representing a 4.2% for the month of November. And yet, as we mentioned yesterday, Jerome the Joke Powell said during his conference that labor markets were by so many measures hotter than it ever ran. Pay attention to what I am about to say now. This is very key to understanding why me and now the market as a whole is not feeling so bullish and confident. The ratio of job vacancies to the number of unemployed is at a record, and this is taking place while wages are rising. This is why Powell is low-key freaking out along with the other Fed officials, even as he fakes confident bravado during press interviews and public hearings. With job vacancies growing with higher wages, you would expect unemployment to drop, but that is now what is happening. It defies common sense and logic, at least if look at it superficially. The Fed simply doesn't know how to handle this, and it's why this culminated on their decision to taper bond buying more quickly. As you know by now, the Fed signaled they will raise rates 3 times next year. Some people are assuming that the increase in wages being seen across all sectors is why inflation has grown, which is a very wrong assessment. In fact, I consider wages to still not be anywhere near where they should be. The reason why inflation has reached a 39-year high is because demand is far higher than supply, and this applies for housing, for cars, and other durable goods. The role wages will have on inflation is in determining how persistent inflation will be. Higher wages will help push demand up, which would be good in a perfect world, but given the constraints being seen by supply, it isn't going to do much. The real issue, as stated, is the reduced supply of labor, which is a fancy word for the higher level of unemployment we are seeing. Among some of the factors causing this, you will find accelerated retirements, generous unemployment insurance, which now has expired, You will find also a huge shift in what younger people seek out of their jobs, as they demand better treatment and better pay, or they will call it quits. To make things worse, which is the fear of most economists, we now have Omicron, which is the new variant that is slowly unleashing havoc in the markets. Depending on the impact it will have and how it will manifest in society, we could see more people leaving the labor force for fear of exposure. Though we have seen a shift in work from home, there still is a huge amount of people having to report to job sites. Many people have dire health conditions which makes them prone to getting sick or being more likely to die. Also, something a lot of people love to forget is that the health system in the United States is an absolute joke, and that for some people getting sick could mean a six-figure bill after a 3-day stay at a hospital. Omicron is more serious than people think because its impact on society, and therefore the economy, is more felt given that our country's systems and foundations are so decrepit, outdated, and outright medieval. This pandemic has shown just how fragile our country really is, and the fact that politics have blown up the way they are show just how anxious, upset and frustrated we are as a country. The Fed has a serious dilemma, and that is that they are right in their belief that the variables holding down labor supply will go away, which will result in the economy bouncing up. The problem is that this could take years. Omicron is here, who knows what other variant pops up in the future, and people are quitting jobs at record level because employers are not providing good enough wages, even if they are rising statistically. The other day I saw a big post saying T-Mobile will raise wages to $20 an hour. That sounded great, until you remember that a huge portion of their workforce is actually outsourced to small companies that pay people the absolute minimum, making this announcement come off as a PR stunt rather than an elaborate show of goodwill. The issues facing this country are serious, and the Fed cannot anticipate a good timeline by which we should bounce up because so many variables are unknown. Knowing this, we now get to compare some of Jerome Powell's statements to facts and reality, and get to see how some of the things he said are just ridiculous. When he stated, and I quote, "The labor market is by so many measures hotter than it ever ran. Knowing what you know now, does this feel like a legitimate and truthful statement? Does this feel honest and give you credibility as to what the Fed's approach and level of control is?" A huge no for me, and guess what? The market is not thrilled either. Wall Street and friends are corrupt and evil, but they are not dumb. There is a reason why they own and run the world. Markets are uncertain and weak, and many are saying this could be the beginning of a bear market looming ahead. I am hopeful for more dips though, so big shout out to this crappy world economy for making it easy for me to buy more. Last thing I wanted to mention, and this is for my European viewers, is that the European Central Bank said it would be phasing out an emergency bond buying program while simultaneously ramping up other stimulus measures. This diverges away from the way the Federal Reserve is going, and underscores the challenges facing policymakers. They are in the process of hustling out trillions of dollars in stimulus policies and moving toward higher interest rates. Again, I think this is smart. You want to keep money flowing and people spending. Supply chains are a problem, but they can be solved, but if all of a sudden people get a tight wallet and decide not to spend, that would be the worst thing that can happen, even worse than a new variant more lethal than anything we have had. A capitalistic society scared to buy when the model of economy is based on consumer spending will send them to the dark ages, and Europe acknowledges that and is working around it. I think this is enough talk about the Fed. I hope I was able to explain a couple of concepts down a little better today. We have had so many news, and I know these are new concepts for a lot of you, so I decided to slowly break things down so make it more digestible for some of you. I thought it was going to be a brief video, but ended up making it much longer than anticipated. Sorry about that. Let's now talk about today. The Fed submitted over $1.657 trillion in reverse repo operations today. Dark pool trades for AMC accounted for 61% of the total volume today, while dark pool trades for GameStop accounted for 44% of the total volume today. AMC had a larger amount of buy orders than its sell orders, with GameStop also having a larger amount of buy orders than sell orders. Now, let's talk about performance. AMC traded bearishly, losing under 1% for the day. It traded pretty weak during the pre-market, and as it closed to opening hours, AMC started breaking support more and more often. Upon market opening, AMC fell below the VWAP and would bounce a lot from the lower band of VWAP. It would keep breaking support, eventually reaching 24.09. Once here, AMC started breaking resistance, running past the VWAP even if for a short brief moment. After shorters hit the stock again, AMC fell back down to 24.34. It would attempt to break the VWAP one more time but would be unable to, and instead would fall back down and close at 24.45, below the VWAP. As for what to expect for tomorrow, AMC will find support at 24, 23 and 22. It sounds obvious, but it appears support and resistance walls are being formed around each dollar figure. Resistance will be met at 24.88, 26 and 27. GameStop traded bearishly, losing over 2% for the day. It opened to a small run to 154.44 before shorters took it down. GME was breaking support for almost the entire trading day, going from 154 to 141.89 at one point. Here, GameStop would bounce back a little, but ultimately close at 144.59, below the VWAP. As for what to expect for tomorrow, GME will find support at 142, 136 and 133. Resistance will be met at 147, 152 and 156. GameStop is weak, and shorters are making it bleed, and I am buying as much as I can right now. Thank you all for watching my video. That is all I have for you guys today. Let me know what you think of the video. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day and to the moon.